I've been doing this for over 40 years. I managed money through Black Monday in 1987. I navigated the dot-com implosion. I was one of the few people who saw 2008 coming clearly enough to position around it. And I want to tell you something before we get into any of this. I don't say what I'm about to say lightly, and I don't say it to scare you. I say it because I think you deserve to hear it plainly, without the Wall Street spin, without the television cheerleading, and without somebody trying to sell you something at the end of a sentence. Bank of America just published a research note. The title of that note is "The Door to Doom Has Opened." Now, I've been around long enough that I've seen plenty of dramatic titles from banks trying to get attention. This is not that. When you actually read what's inside that report, what they're describing is not theoretical. It's not a forecast based on vibes. It's a pattern, a specific document historically consistent. And right now, multiple pieces of that pattern are lining up in a way that I haven't seen line up quite like this in a very long time. So let's walk through what they're actually saying, and then let's talk about what you actually do with it, because that second part matters just as much as the first. The first thing Bank of America is pointing to, and this is the one that grabbed my attention immediately, is the 30-year Treasury yield crossing 5%. Now, I know that sounds like something only a bond trader should care about. Let me make it real for you. When you lend money to the U.S. government for 30 years, the government pays you back with interest. That interest rate is called the yield for the better part of the last 2 decades. That yield has lived well below 5%. It's been suppressed, held down, and that suppression created a kind of artificial floor underneath asset prices, underneath stocks, underneath real estate, underneath everything. Because when borrowing is cheap, people buy more, companies expand more, valuations stretch further. That's the world we've been living in. When the 30-year yield breaks above 5%, it means the people with serious money, the ones lending to the U.S. government, are getting nervous. They're demanding more compensation for the risk of holding U.S. debt for 3 decades. That's not a small thing. That's a very large thing. Bank of America looked back through every major bubble and crash in modern history. Japan in 1989, the dot-com collapse in 2000, the housing crisis in 2008, and in every single case, the unraveling began with long-term government borrowing costs rising to a level that the market simply couldn't absorb. The dam cracked, and then the water came through. We are at that dam right now. The second thing they highlight is what happens to markets when inflation runs above 4%. And this part is almost mechanical in its consistency. Going back 100 years of data, when consumer prices are rising above 4% on a sustained basis, stocks fall roughly 4% over the following 3 months, and then another 7% or so over the following 7 months. Now, individually, those numbers don't sound catastrophic, but you have to understand the context we're sitting in. Consumer prices are running close to 4% right now. But here's the thing that most people aren't paying attention to: producer prices, which are basically the prices manufacturers pay before those costs get passed on to you, are running at 6%. Producer prices lead consumer prices. They're upstream. So what Bank of America is telling you is that the inflation number you're seeing today is not the peak of the story. The story isn't finished. And when inflation gets to 5%, which they think is where we're heading, the Federal Reserve has almost no good choices. They either raise rates and crush economic activity, or they sit still and let inflation eat away at everyone's purchasing power. Neither of those outcomes is good for stocks. Now, here's something that I've been watching personally for the past several months, and it's the thing that concerns me most. There is a gap right now between how the stock market is performing and how the bond market is performing, and that gap is historically enormous. Bank of America uses the term alligator jaws to describe this picture. The top jaw is the stock market moving higher. The bottom jaw is the bond market deteriorating, and the jaws are as wide open as they have ever been in recorded market history. The thing about alligator jaws is they always close. They have never stayed open, not once. The only question is, which jaw moves? Either stocks come down to meet bonds, which is a historically common outcome, or bonds somehow recover sharply to meet stocks. which would require inflation to disappear almost overnight. I've been doing this long enough to know that inflation doesn't disappear overnight. So if I'm being honest with you, the direction that gap most likely closes is downward, and it closes fast. Let me give you some historical comparison that I think is genuinely important. In 1989, Japan had what was at the time the most spectacular stock market bubble the world had ever seen. Property prices in Tokyo were so inflated that the grounds of the Imperial Palace were estimated to be worth more than all of the real estate in the state of California. And then it popped. Japan's stock market fell 80% from its peak, and here's the part that should make you pause. It took 30 years to get back to where it started. 30 years. Entire retirements wiped out. People who thought they were financially secure in 1999 were still waiting in 2019 to get back to even the warning signs before that crash. The exact data points that preceded it are what Bank of America is now seeing in the United States today. I'm not saying we are Japan 1989. I am saying the resemblance is close enough that I think it's worth paying very serious attention. On top of all of that, there's the concentration problem. Right now, the top 10 stocks in the S&P 500 have driven 72% of the entire stock market rally this year. 72% from just 10 companies. The other 490 companies in the index have essentially done almost nothing collectively. And those 10 companies are almost entirely in one sector, technology and semiconductors, the AI chip theme. When you have that kind of concentration, the whole market becomes hostage to whether that specific theme continues. If something cracks in that theme, if earnings disappoint, if there's a policy shock, if global demand for chips softens, you don't get a modest correction. You get a trapdoor. A fast, violent move downward that catches almost everyone off guard. Bank of America specifically compared the current semiconductor situation to only two prior periods, the Mississippi bubble in France in the 1700s and the dot-com bubble in 2000. Those are not comparisons that a serious institution makes lightly. Now let me step back for a second, because I think this is where a lot of commentary goes wrong. They describe the danger and they leave you sitting there feeling helpless. That is not useful to you. I spent my career not just identifying risk, but figuring out what to do about it. And what I want to share with you now is the other side of this conversation, because the other side is actually quite extraordinary if you know where to look. Every single major crash in my lifetime has created more concentrated wealth transfer than almost any other economic event. Not wealth destruction, wealth transfer. The people who panicked and sold at the bottom lost. The people who had a framework, a clear-eyed, unemotional, rules-based framework, came out the other side in a fundamentally different financial position. I watched it happen in 1987. I watched it happen in 2000 and 2003. I watched it happen in 2009. I watched it happen in 2020. In 2020, when the market collapsed during the COVID panic, a copper mining company called Freeport-McMoRan traded down to around $5 a share. 24 months later, it was trading above $50. If you had put $10,000 into that stock at the low, you'd have had close to $100,000. Royal Caribbean, the cruise line that everyone thought was finished, went up 9 times from its bottom. Zoom went up 7 times. Block went up 7 times. The average recovery winner across the board rallied 5 times in under 2 years. In 2008, same story. Bank of America, which the media was reporting might not survive, went 8T up 6 times from its bottom. Freeport-McMoRan did it again 7 times. Caterpillar 5 times. Cyclical, commodity-driven, beaten-down businesses that people had given up on. So how do you find them? Let me give you the actual framework. Not a vague gesture toward opportunity, but the specific logic I use. The first thing you're looking for is what I call deep value in good businesses. When fear takes over markets, it doesn't discriminate very well. Automated selling kicks in. Leveraged investors get margin calls and they sell whatever they can, regardless of quality. Good companies get dragged down alongside bad ones. That creates the opportunity. What you're looking for specifically are high-quality businesses that are down 70% or more from their previous highs, not just cheap stocks. Cheap stocks can stay cheap forever. You want quality companies that are cheap because the market panicked, not because the business is actually broken. The second filter is what I call secular tailwinds. And this is the one most people miss. The biggest winners in every recovery weren't just recovering to where they were before. They were recovering and then blowing past their old highs because the underlying trend in their business was genuinely accelerating. In 2020, Zoom wasn't just a company that recovered. It was a company that was riding a once-in-a-generation shift to remote work. That's why it didn't just recover. It went to the moon before eventually coming back down. In 2009, Freeport-McMoRan wasn't just recovering from a panic. It was riding the early stages of a massive global infrastructure build-out, particularly in China. When you combine a deeply oversold stock with a business that has a genuine multi-year tailwind behind it, you get the kind of returns that most people assume are only possible in speculative assets. The third thing I look for is what I'll call government backing. This sounds cynical, but it's pragmatic. Modern governments, particularly the United States government, do not allow systemically important industries to collapse. They step in, they write checks, they provide loan guarantees, they inject liquidity. The financial sector in 2008, airlines in 2020, energy companies through indirect support, defense contractors almost constantly. When you're looking at what to buy in a crash, one of the best filters is asking yourself whether the government can afford to let this industry fail. If the answer is no, the recovery is almost guaranteed. It's just a question of timing and magnitude. And the fourth element, which also keeps coming up repeatedly in historical data, is the commodity cycle. Every economic recovery, without exception in modern history, has required physical materials, copper for electrical infrastructure, oil for transportation, steel for construction, lithium for batteries. The companies that produce those materials, not the traders, but the actual producers, with low debt loads and the ability to survive a period of low prices, have in every single cycle produced extraordinary returns in the 2 years following a crash bottom. Freeport-McMoRan showed up in both 2008 and 2020 for exactly this reason. It's not a coincidence, it's a pattern. Now, knowing how to find these stocks is only half the equation. The other half, and I would argue the more psychologically difficult half, is knowing when to sell. Because if you bought Peloton at its crash bottom in 2020 at around $20 a share, you had an extraordinary gain at its peak of nearly $200. But if you held it through everything that followed, you'd be sitting on a loss of roughly 75% from that entry point today. Good companies can become bad companies. Themes can reverse. Valuations can overshoot to the downside and then overshoot to the upside and then collapse again. The solution to this, and I've lived this personally for 4 decades, is to remove emotion from the process entirely. You establish your rules before you buy. You know exactly under what conditions you'll add to the position and exactly under what conditions you'll reduce or exit. And then you follow the rules, not your feelings at the moment. When markets are crashing and your portfolio is down 30%, you are going to feel terrible. Your instinct will be to sell everything. Your rules need to override that instinct. When markets are euphoric and everything you own is up 3 or 4 times, you are going to feel invincible. Your rules need to override that too. I want to be direct about one more thing. I've heard a lot of people say lately that this time is different. Usually what they mean is that artificial intelligence is such a transformational technology that the normal rules of valuation and cycles don't apply. I've heard that argument before. I heard it in 1999 on the internet. The internet was genuinely transformational. It changed everything. The companies that were 60% above their 200-day moving averages in 1999, and in some cases 100% or 150% above them, still collapsed. The technology was real. The valuations were not sustainable. The technology being real does not protect you from the price you paid being wrong. That's a distinction that I think a lot of people are going to learn the hard way over the next 12 to 18 months. Here's where things stand practically as I see them. There's an OPEC meeting coming in early June that could significantly affect oil prices and inflation in either direction. There's a G7 summit that will matter for trade and geopolitical stability. And there's a Federal Reserve decision coming up from a new chairman under substantial political pressure to cut rates, a pressure that the underlying inflation data is making almost impossible to act on. The market wants rate cuts. The data does not support rate cuts. That tension resolves eventually, and it doesn't usually resolve quietly. None of this means the crash starts tomorrow. I can't tell you that, and I won't pretend to. What I can tell you, with the conviction that comes from having watched these patterns play out over and over again across 40 years, is that the signals Bank of America is describing are real. They're historically consistent. And the window to prepare, to build your watch list, to understand the framework, to set your rules before the emotion hits, that window is now, not when it's already falling, not when the headlines are terrifying and your friends are calling you in a panic. Right now, while it still feels optional, the people who come out the other side of major market dislocations in a genuinely better position than they entered them are not geniuses. They're not lucky. They're prepared. They did the work when nobody made them. They understood what they were buying and why. They had rules for when to buy more and when to get out. And when the moment came, they acted on those rules instead of their fear. I've made more money from crashes than from any other single type of market environment. Not because I enjoy watching people suffer, but because prepared capital meeting panic-driven prices is the most reliable, return-generating opportunity that exists in markets. And that opportunity, based on everything I'm seeing right now, is likely coming. The only real question is whether you'll be standing there ready to take it, or whether you'll be one of the people selling to somebody who was. That's the choice. And you have time right now to make it deliberately,